episode 24 of Top of Mind with Consilio Wealth. On today's episode, we are going to talk about the most obvious recession that just doesn't seem to happen. We are going to talk about the debt ceiling, which is probably the most in the news topic. We've got a couple of emails from our clients on this, so we thought that we would address it here live. Year-to-date performance in the markets that you would not have predicted on January 1st. Just some interesting things on what's going on with the various asset classes this year. And finally, what Target and Home Depot earnings tells us about the economy. I am joined as always by Hao Dang, and it is May 17th, 2023 at 9:54 a.m. How the market is up 7.7% year to date. By the market, I mean the S&P 500, and international is up 11.5%. So that's some good news, but maybe you can help our listeners understand how in the world has that happened so far?
Yeah, as what everyone expected for this year, right?
Yeah, totally.
Heading into the year with decades high inflation, impending recession, Ukraine, you name it, right? What government
strange
dysfunction,
job market, high interest rates, weird real estate stuff going on.
Yeah, we're expecting a crash, and people are spending our way out of it, maybe.
Yeah.
But I think this is going to be the theme of our episode, where we've always said get invested, stay invested, because you never know. And again, we read all this stuff too, obviously, right? So if you're seeing the headlines, it's most likely already priced in or priced forward, or what does the other side look like? That's what the stock market tends to do. Doesn't get always wrong because it's based on predictions, right? There's something that could rock us that we're not seeing. Mm-hmm. But all the stuff that we're going to mention today, we're seeing. It's obvious, right? It's being reported. And we've always said anything in the financial news is history. It's already something that's already happened. And did we see this 8% up on an S&P? No way, right? 11.5 in the international markets? No way. Their inflation was worse than ours. And how are they doing better, right? And
they didn't necessarily fall further, by the way.
Correct.
Last year, yeah.
Yeah. And right now, the performance has been so good in the last 3 years. Internationally is ahead of U.S., which is just a weird stat to think about because everyone assumes the U.S. has been so dominant. Mm-hmm. We're not saying the tide's turning, but we're saying get invested, stay diversified. I think that's, even if, all the data is, not the data, but the headlines are pointing in a different direction, right? You should be doing this, you should be doing that. And I think that's what we're here to dispel.
You have an interesting quote here. This is from the National Bureau of Economic Research, and there have been 30 recessions since 1871, which is the longest period that performance data is available for the S&P 500. And if you look at how the S&P 500 performed 6 months before each of those 30 recessions, you would find that it had a positive return 21 out of the 30 times. So even if you knew that a recession was coming, and as we like to say, the media has accurately predicted 20 out of the last 10 recessions, even if you knew this recession was coming and you knew when exactly it was going to happen, you still most likely would be better off not changing anything and just staying in.
Or even better, continually buying every time you get your paycheck.
Sure. Yeah.
Now, the shape you're in since the bottom of October of 2022, if you were able to keep your job, which most people have, according to
very
the
strong.
Very strong labor market, and if you have a 401k or you're contributing in some other form, you've been buying lower, and you've been benefiting from it.
So why is this the most obvious recession that just doesn't seem to happen?
96% of economists are saying a recession's coming late 2023 or early 2024. This very specific time frame. And anyone you ask, right? Non-economists as well. It's like, there's got to be a recession coming, right? But then you go to a restaurant or you go out to anything that is activity-based, right? Go to a golf place or go to a bowling alley. They're not empty by any stretch. They're at near capacity. So the consumer is spending in different places. And again, we'll get to Target and Home Depot, like Chris mentioned, but I think there's quite a bit of spending going on. And if this continues, you don't get a recession if the consumer is spending the way they're spending. Right? And we understand things will change because of that, because unemployment should tick up. We're at still 3.5%. The target is 5%, so 1.5% unemployment increase, which, that's millions of jobs lost. That could probably do it. If you lose your job, you probably aren't going to the bowling alley or Topgolf.
Yeah. Well, and I know that spending has softened a little bit, but clearly not by a whole lot. And it does seem to be across the board. You've got business spending and consumer spending, right? So we reported on big tech earnings about 2 weeks ago, which was a total blowout. I mean, big tech just absolutely crushed it. They crushed it in two ways, though. They had some revenue growth in general, but they maintained or grew profits. And that could be in part, or was part, because they controlled expenses through whether it's layoffs or just changing around some research and development projects and CapEx expenditures and those kinds of things. However, what was reported in there for companies that work directly with other businesses, like, say, Microsoft, it was reported that other businesses are slowing their spend. Microsoft and Amazon talked about this with their cloud services. Is, hey, we're seeing smaller contracts or contracts getting renewed at the same level when they normally would be renewed at bigger levels. So some spending is changing, but to your point, how people are still getting on airplanes, people are still filling up their cars with gas, which, by the way, gas is not as cheap as it was a little bit ago. Seems like that missed the news. Whatever.
Yeah, well, egg prices dropping seem to miss the news too.
Which I never see. Anyway, I feel like I stare at these prices now at the store because I'm
so sensitive to inflation, right?
Yeah, well, I'm waiting for it to go down like 50 cents or something, and then you tell me that egg prices drop, and I'm like, well, that's really great, but when egg prices drop, I guess it's really just it's a raw material type thing. It's not like Kroger is going to lower their prices by 50 cents. Maybe they are, and maybe they do. I just don't see that at my grocery store. I don't see
Sure.
the price moving by 50 cents every week to adjust for the actual cost of that raw good.
Well, eggs are perishable, so if grocery stores aren't dropping their prices on eggs, they're going to be stuck with a lot of rotten eggs. And I think that's what makes perishable commodities, so sensitive to pricing, right? Because people aren't buying bananas or apples. Well, they only have a shelf life of a few days, right? If you're not selling them, you have to lower prices.
Let's move to the debt ceiling. We've gotten a handful of questions from clients on this. I think that, like most things these days, this is probably the most in the news. This whole thing has been. I just want to start by saying, in the last 100 years, over 100 times, the debt ceiling has been raised or suspended. Suspended meaning there was no debt ceiling for a period of time. This is actually very normal, and it's just that we all know about it a lot more because the media loves this, and everybody writes an article around, what has good SEO, and well, look at us, we're talking about it too. So I guess maybe someone will YouTube search us and they'll land on our video because of the debt ceiling.
Yes, debt ceiling, debt ceiling, debt ceiling. Hopefully.
Yeah, let's say it a few more times. Yeah. So how you had some interesting stats on like how this started to become a thing in 2011 and just kind of when it became, I guess, popular or media popular to the average person. And I just thought it might be helpful for our listeners if you could unpack that data a little bit.
Yeah, your context actually helps a lot where, since 1917 was when the debt ceiling officially became a thing. 1917, so over 106, 107 years at this point, where up until 2011, we haven't had any debt ceiling drama. It's always been par for the course, right? Congress would meet, negotiate a little bit, and then raise the debt ceiling or suspend it.
Yeah.
So it became an issue in 2011. It was an issue again in 2013, and an issue again in 2018, much less so, and now an issue again in 2023. So it seems like the party not in power is using the debt ceiling to generate anger or raise uncertainty.
But isn't that always how it's been? It's always been
politics,
one
right?
party's in power, we're going to try to get something. So the difference is that we all just know about it now almost in real time. I mean, Biden had met with
McCarthy.
Yep. And the first headline was nothing happened. Who cares?
Yeah. Well, it's the first meeting. Yeah, of course. You're not going to, again, you're dealing with trillions of dollars.
Right.
And you're not going to have a single meeting and have it resolved in a single meeting or within a few hours, right? There's a lot at stake for both sides who, Democrats want more social programs, more social spending. Republicans want to rein all that in, right? We try to be neutral, but it's only been recently weaponized. I think that's the point I was making since 2011, where someone found this, this negotiating tactic and used it to essentially hold the country hostage. And it did run into problems in 2011 and 2013 in terms of government shutdown, at least temporarily.
Mm-hmm.
So what happened there was we couldn't reach an agreement, our credit got downgraded, and we still had to pay our debts. So when you have a loan out, in this case, I owe Chris money, my credit quality drops, I have to pay more in interest to make up for the heightened risk that Chris has taken on by loaning me money in the first place.
Mm-hmm.
So what happened was we technically did default. We didn't miss payments, but technically what happened was we pulled money from other sources. Worst case scenarios, we pull money from Social Security, Medicare, other entitlement programs that have bigger budgets to pay debt, right? So if China owns our debt, we have to pay them, right? We could print money. Can't really print money in a non-lifted debt ceiling scenario like this, because that's in a technical term, that's why we can't pay or operate the way we've operated. So that's technically a default where we're robbing Peter to pay Paul, essentially, right?
Now I understand this is two different things. And so the first is, let's say debt ceiling isn't raised, we can use other money and other checking accounts elsewhere, which is, okay, Social Security has a checking account, or this other service has a checking account, and that has 6 months of runway in it before we need to issue more bonds to refill the checking account. And so we can use that money in an emergency situation. And then it's required that it's paid back as soon as the debt ceiling is raised. So
exactly.
First and foremost, we want people to understand this isn't, if it goes this route, it's not taking money from Social Security, which is further hurting Social Security. It does get repaid.
Yeah. Well, imagine your family budget, your car breaks down, you're going to take money out of your medical savings and take from that bucket and put in this bucket. So technically, in pure definitional terms, it's defaulting because the money that we had earmarked for this isn't available, right? So, but the worst case scenario, actually.
But the second thing that I understand there is we have monthly interest payments on these debts, right, on these bonds, but really those don't get defaulted on. We're borrowing money from somewhere else to pay those debts, but a real default would happen if one of these bonds matured and we didn't have the lump sum to pay back the bond. So for context, when a bond is issued, a lump sum is received. Let's say we issue $1 million bond as the country. So a bond is issued for $1 million. The country gets $1 million in their bank account, and then they start paying these monthly interest rates or interest coupon payments on that. If it's a 10-year bond, at the end of 10 years, that $1 million is paid back to whoever bought the bond. And so to the investor in that bond, they got their original $1 million back, plus they earned all the interest over time. So that's how bonds work. And so I guess what I'm trying to unpack here is you have kind of this technical default, which is, okay, we don't have the money to pay our interest payments, but we are anyways because we're borrowing it from somewhere else. But then the real default would happen if a bond came due and we literally didn't have that same $1 million to pay it back.
That's correct? That's the worst scenario where we go from technical to default, right? So you did a really good job of explaining what probably a worst case scenario is we're no longer good for our debts. One that has big global ramifications. So government shutdown, people losing their pension, Social Security, Medicare. I think a lot of those can definitely be replenished. But I think in this case, if we're no longer good for our debts, we're devaluing our currency because people lose faith in any kind of U.S. related government debt. And again, this is doomsday scenario where very low likelihood of it happening. So Chris did a timestamp. Joe Biden and Kevin McCarthy came out of their Tuesday meeting yesterday and said they have enough common ground to come up with a solution to raise the debt ceiling, right? And that's probably why the market is already reacting pretty positively, right? And no agreement has been made, but the doomsday scenario doesn't seem like it's going to be the biggest issue.
So that's kind of the worst case scenario that we've covered, and sort of what could happen if we default. And there's multiple levels of this, or I shouldn't say if we default, just if we don't raise the debt ceiling. There's a handful of things that would happen before we actually default on debt, which to my knowledge has never happened before in the U.S.
Never happened. Correct.
Never happened before. Pretty unlikely. It doesn't mean that this won't be in the news daily, but it's pretty unlikely that it gets this far. What I thought it would be interesting to talk about is our view on markets related to the risk of this situation. And I'll just share kind of my high-level thoughts, and then I want to hear yours. Our thinking in general is if the debt ceiling is raised in time, right? We didn't bump into it. It's raised before we actually hit the ceiling. Our thinking is that the market might react positively anywhere from, say, 0 to 5%, because some of this is already priced in, right? The market might have no reaction when the debt ceiling is raised because they might have priced in that it's going to happen anyways.
Yeah.
No one knows until we know. If the debt ceiling isn't raised and we get into this sort of political gridlock, that could cause markets to come down because it creates further uncertainty. Markets hate uncertainty and they tend to sell off in the face of that. Our thinking is that downside could be anywhere from, say, 5 to 15%. Here's the risk. What if someone were to make a material change to their portfolio, or worse, get out and go to cash because they're trying to miss that down? A, we don't know if the down will actually happen. We don't know by how far. And the key in getting out, which we never recommend to clients, is you also have to know how to get in and when. And there is never going to be a flashing green light that says now's the time to buy back in. In fact, the news will always get worse if you are the one that went to cash.
It's always something new, right?
If the market goes down from your sell point, you're like, cool, it'll go down further. It'll go down further. I'll get in lower. If the market goes up from your sell point, you will likely start thinking, okay, I'm going to wait. It's going to come back down. I'm going to wait. It's going to come back down. And those things may never happen. So I would strongly, strongly, strongly caution anybody that's considering making major or even really kind of minor changes to their portfolio, because long term, we've been through this over 100 times and the markets generally push forward.
Yeah, and markets don't care about your feelings, or they don't care about what you read in the headlines, right? Again, if headlines didn't exist, the market still would fluctuate, right? The headlines are just giving it some kind of a label. Oh, the market went up because of the X or went down because of X. And our definition, Chris, it's always more buyers than sellers or more sellers than buyers. It's that simple. And if you were looking at sentiment, which is at a historical low, which is so insane to me, how is the sentiment lower than it was in 2008, 2009? But How many times people look back at those S&P charts and said, why didn't I buy in 2009? I was still employed. I was one of the lucky 9 out of 10 people, right, who still had a job. And I didn't buy. And because I'm suddenly brave after the fact. I'm never brave in the moment. And that's what makes hindsight investors so dangerous, is they always think that they always had a cool head when it wasn't the case, right? If you're thinking about going to cash now, you're not cool-headed. I think you're not looking at this as an opportunity. You're looking at this through a lens of fear. And I think that's an incredibly dangerous way to invest. At the same time, it's a dangerous way to invest completely contrarian, meaning you always see doom and gloom and the apocalypse as an investing opportunity. I think that's very unhealthy as well.
Sure.
But I think we're trying to rein it more optimistically, because I think if we saw speculation like we did in 2020, if we were doing this podcast then, we probably would have started asking people to start rebalancing, start trimming a little bit, right? Mm-hmm. I know things are good, but nothing moves up perpetually all the time, and nothing moves down all the time. Mm-hmm. So if you think you know exactly what the market's going to do based on news that you're seeing, trust me, people like Goldman Sachs, Merrill Lynch, JP Morgan, all have algorithms that are parsing the data and information in a much grander scale and much deeper scale than any human can do, right? I know we're in the midst of this AI push. Firms have been using AI for quite a few years to do exactly what you think you're doing with your portfolio.
I want to add to that. When the markets come down, so if you're a client of ours, you'll remember this. I guess you've been a client of ours for a couple of years, that is. We, in 2020, as the markets are falling in COVID, we send out what we call a call for cash email. And we have certain targets that, when the market falls quickly and by a certain amount, we just send out an email to all of our clients, and we effectively say, hey, we have no idea where the market bottom is. We aren't market timers. It's down from its highs. PE ratios look better. If you have cash, send it in. With that said, it's a crazy time, and, don't use your emergency fund because you never know if a job changes or, something happens, right? I followed my own advice in that, which I always do anyways when we send out these emails. So I actually drop in some of my own money, and that is one of the times I wish I did more. To your point earlier, it's not all about just, okay, markets go down, I want to buy, but, and when that happened, that was admittedly probably one of the best trades I've ever made, just dropping money into the diversified portfolio when it had fallen 30% in like 2 weeks.
Yeah.
Fantastic. So keep a cool head, to your point, and just kind of follow the plan. If the markets do drop, feel awesome about your 401k contribution in that month.
Because you're buying.
If you're sending money monthly into your other accounts, feel awesome about that month. And know that when you're doing that, you're going to look back on that decision or that month down the road and say, that was one of the best investments I ever made.
Yeah. And I think the biggest investment regrets are people missing or stewing on the opportunities missed, right? Mm-hmm. It's always in 2013. I should have invested in 2010. I saw this coming because, you've heard it all. And it happens on the flip side too. It's like, well, I knew I should have pulled my money and put it into cash because I saw this crash coming. No, you didn't.
Look at the chart, you're like, I knew right there I was going to sell, and right there I was going to buy.
Correct. And I think the first article that Chris mentioned from Bloomberg is the stock market is up 21 out of 30 times in recession. So the odds are we're going to have an up market.
Recession.
Yeah. So in the debt ceiling, 2011, the market sold off about 16%. Guess what it ended up at? So the sell-off happened in August. What did the market end at in 2011?
I don't know. You tell me.
0. So we had a 4-month, 16.5% rally. Mm-hmm. Well, probably more because, you drop 16, you need I don't know the math right away, but you need more than 16% to recover a 16% loss. So anyone who was brave enough to buy into the Greek debt crisis, right, which was at the same time as the debt ceiling crisis, you were paid off handsomely if you stayed invested in 2011 and stuck around for 2012 and stuck around for 2013, because 2013 was another 30% up year. So again, we're running a marathon. We're not sprinting here.
Let's shift into the year-to-date performance of the markets and the various areas of the markets that no one would have ever predicted as of January 1st.
We did, right?
Of course we did. So we wanted to just highlight this. We've got some year-to-date data just on indexes. So this is just looking at January 1st to the close of business yesterday. So that timestamp is through May 16th market close. And the top performing asset class is, guess what? International. International stocks like Europe. And it's up 11.4% this year.
Beating everyone by a large margin. Yeah.
Beating everyone by a large margin. Large cap US, so that's S&P 500, is up 7.7%. If you did not tune into our last episode, we highlighted how just 7 stocks are what pulled that index up.
Yep.
Without those 7 stocks, which happen to be this run in big tech that's happened, market would be up something like 1% to 2% on the year. And the third best performing asset class is, what is it, Hal?
A diversified portfolio.
Diversified. Well, that's a 60-40. But
60-40.
The third.
Yeah.
So the third best performing asset class is
emerging
markets. I just saw this and I had to highlight because I had this epiphany the other day. And if you put me in a room on January 1st and you said, "Hey, Chris, what are your predictions for the year?" Right?
Exact opposite of everything, right?
Oh, and I should have mentioned before I go there, what's one of the worst performing asset classes this year?
Commodities.
Small and mid companies. Small and mid-sized U.S. companies, which are negative on the year. Okay, if you put me in a room January 1st, I would have never told you that, A, Europe, which has, say, 10% inflation, they're heavily dependent on foreign oil, their economy is not doing great, arguably relative to the U.S. at least, job markets aren't good, yada, yada, yada. I would never have told you that that would be the best place to invest this year. Secondly, I never would have told you that emerging markets, which is predominantly dominated by China and India and others, but those are the 2 big ones. You talk about all the negative press around the Adani Group in India. You talk about the political environment in China, and their economic restart and recovery and this kind of thing. You're telling me that's one of the best places to be this year? And finally, I would have never told you on January 1st that we would go through a regional bank, I'll call it a crisis in the U.S., where we've had failure after failure, takeover after takeover in small regional banks, and those companies are a heavy weight in mid and small U.S. indexes, and that's why those indexes are flat to negative on the year relative to giant companies, which are up almost 8%. I could have never predicted any of that stuff with any level of accuracy. And it just speaks to how we can't try to get too fancy with it. We can't try to say, go all here or go all there because of what I think. Because if you did, I would argue that you would have completely missed international, which has been such an additive holding in portfolios this year. And again, there's no way that anybody would have said, let's sell mid and small companies.
Well, I'll throw in another one, asset class. I mentioned it when you were highlighting small and mid cap. Commodities, I think they're the worst performing sector in the whole group, down 9% on the year. But if you were to ask me on January 1st where I thought commodities were going, I thought higher, right? Because everyone was like, commodities are so expensive, they're going to get more expensive. And we never really touch on commodities because that's not our expertise at all. But who would have thought that asset class, like oil, copper, iron, lumber, that's all down 9%. And we have said their commodities are cyclical. Like we mentioned, gas prices in the summer were predicted to go $3.65 a gallon. It touched $3.21, so nowhere near the target. Like it was a healthy amount off from the prediction. And the biggest mistake people make is assuming a trend will keep going the way it's going.
Momentum, yeah. Commodities, for context, has been the absolute worst place to be for a broad-based index in the last 15 years. And it has commonly returned negative returns year over year, with the exception of 2021, and it was up 27.1%, and 2022, which was up 16.1%. And so it's no surprise that this year it's negative about 9%. And these are broad baskets, right? I think I predicted that, but I won't take the full credit.
Well, when was the last time you saw an oil company create value like Microsoft does or Amazon does?
And they had insane profits last year, right? This has to change.
Yeah. Like, I can't think of a better situation in the last 2 years for an oil company. Yeah, they've probably had their best 2 years in a while, but it's nothing lights out.
Let's shift over for our final topic today, which is what Target and Home Depot earnings tells us about the economy. So Target just released yesterday, and Home Depot released, I think it was the week before last. I thought I would just highlight some interesting things that Target said. And by the way, the reason for these two companies and really these two areas is it highlights consumer spending. Consumers spend money at Target or a grocery store. They buy backpacks, they buy apples, right? And then Home Depot is also a stock that it shows confidence, consumer confidence, because people go and they buy lumber and they buy things for their house and whatnot when they feel like times are good. So Target actually reported pretty decent earnings. Their stock's actually up today. They reported overnight. Their stock's up a couple of percent today. So they beat earnings, but they gave a very lackluster forecast. And most of what they said here, which I thought was interesting, is they said that they're seeing softening in certain sectors of their business. Target is a really interesting company because they sell kind of everything. They sell grocery, they sell lawnmowers, they sell baby stuff. You can buy a barbecue there, right? They sell everything. And they said that they are seeing more softening in some of the kind of extra goods, what they call discretionary merchandise. So things like apparel and home goods. So maybe we're seeing some softening in sort of the, I don't need that, but I want that type of spending.
We talked about it in episode 2, right? We were seeing excess inventory, and Crocs was high up there, and so was Yeti. Yeah, well, admittedly, we bought Crocs for the whole family, but they're super comfortable. But a Yeti is probably sitting on a lot of steel inventory.
And actually, Target commented on that in their earnings here. They said their inventory growth was minus 16% year over year, which was actually really good. Their good consensus estimates were for minus 5.1. So they beat that. They cleared out a lot of inventory. Yeah. And net sales were good, profit margins were good, and this kind of thing. Still dealing with a lot of theft. I think that's kind of an interesting thing that's starting to get reported on earnings. I don't know if I think that's just a fun with numbers thing that's always been there. It's a new line item that companies are seeing charge-offs. I don't know. I don't know enough about it yet. They said that, okay, this is crazy. I'll just comment on this and we'll move on. They said that theft of merchandise. Actually, let me just read this. It says, in its earnings release, Target estimated that inventory shrinkage, which was mostly the theft of merchandise, would clip profits by a whopping $500 million this year. That's insane. Anyway,
yeah, that's a lot of theft.
$500 million in theft. I mean, this isn't stealing candy bars. I mean, this must be higher ticket items. That's wild.
What I found is a lot of stealing is coming from employees. But again, not to trash any employee at a retail store, but it just seems to be the common thievery, I guess, group of retail stores.
Let's shift over to Home Depot. What are you seeing in Home Depot's earnings, and what's similar to this and what's different?
Yeah, very similar. Their earnings, they did beat profit, notably on the not by selling more, but selling less at higher prices, right? And that's what inflation is doing. It's helping their margins. You can see they're healthy margins. Their revenue was down by over $1 billion in terms of expected versus reality. That's a big miss in a quarter, like a really historically big miss. It's about 20 years since Home Depot had gone as a public company without missing revenue that by that much.
Wow. Well,
Yeah.
what's their quarterly revenue? And like, I guess I'm just thinking like,
Yeah.
how big is $1 billion drop?
Oh, sorry. Yeah, context. $38 billion expected, $37 billion
It's not
reported.
I mean, okay, it's $1 billion, but it's not crazy.
No, and it shows you how the loss in volume, right? It's not counterbalanced or counteracted by higher prices, right? You raise prices, you sell less, you make the same amount of money.
I see. Yeah.
It's one of those situations where people are buying less. Very similar to Target, guidance was lowered. They're preparing for a real slowdown in home improvement buying. Right, at least in the way we've seen in the last, let's say 3 years now, right? 2020 peaked. Now it's been gradually to exponentially slowing. It's like we're seeing a real slowdown in Home Depot, and probably with Lowe's. Didn't have the Lowe's article, but I'm sure they're experiencing the same slowdown in home improvement spending.
Stock's up 4% today, Home Depot.
Yeah,
Lowe's is up 3.25%.
you never know.
Interesting. So you're saying earnings was, but then guidance was pretty soft, I think is what you're saying, right?
Yeah, and I see this as an encouraging sign for long-term investors. I think we're setting up similar to 2017, similar to a 2019, where the years prior to those great years, to remind everyone, 2017 had 1% down days in the entire year, right? 2019 was very similar in terms of the S&P performance. Prior to those years, those great blockbuster years were relatively mild to bad earnings. More importantly, earnings guidance. So we're lowering the bar for next year and the year after. What happens if we do get a recession, but the bar is so low we could just step over it? I think that it's setting up for a real good earnings surprise for the following year because all these companies are tempering down expectations.
I think both of these two are really exceptional examples of how the market prices in potentially worse news than actually is released. Home Depot came out, they missed by $1 billion. Just a couple of percent, not crazy, right? But they missed by a margin. They were more profitable and they gave kind of poor guidance. And their stock's at 4%. Why does that happen? I think this is a good reminder that markets sometimes price in a worst case. And when the news is less bad, things jump. Target's the same, right? Target is up today, and Target beat earnings but gave weak guidance, and their stock is up about 2.5% today.
Yeah, I'm curious about Target 2024, in May, because they're pinning on today's whenever they reported a few weeks ago, they're pinning on that forecast. Yeah. And if that forecast is uberly low, even if things are bad, that's not a high bar to clear.
Yeah. Okay. Well, we'll see. We'll see next quarter how they do. Awesome. That's all the time we have today. I got to go. Thanks, Hal. This was fun.
Yeah, it was fun, Chris.
Talk
Thanks,
soon.
everyone.